When we account for inventory using the perpetual system, our inventory cost components remain the same. They include the invoice price plus freight in minus any returns, allowances, or discounts. In other words, anything that you have to incur in order to get that inventory ready to sell to the customer. When we look at journal entries, notice that for perpetual, we do not have a purchases account. Instead, we use the current asset account inventory. So when we buy inventory, we debit inventory and credit accounts payable if it's a purchase on account. And when we sell inventory, notice it takes two entries. First, the entry to record the sale for the selling price, and second, a debit to an account called cost of goods sold and a credit to inventory for the cost of the goods sold, determined either by the FIFO, LIFO, or average cost methods. Here's an example. So here we have Nick's fish again. He's purchasing Maine lobster on October 10th. We debit the account inventory for $76,000, credit accounts payable. When he buys king crab, we also debit inventory, credit accounts payable. Since he paid for the lobster within the discount period, notice he debits accounts payable, but the biggie that you want to look at is he's going to credit inventory because the inventory really didn't cost $76,000 because he got a 2% discount for paying early. So you reduce the inventory account by the amount of the discount and only pay 98%, which is the cash. But for the crab, because he paid after the discount period, he simply debits accounts payable and credits cash. Now, when we get ready to look at the cost flows, again, remember that the beginning balance plus the purchases net has to equal the ending balance plus cost of goods sold. So how is it that we're going to assign costs, flows, to the ending balance and cost of goods sold? Under perpetual, we do a running total, and we're going to focus primarily on FIFO and LIFO. So here's the same problem again, but when we look at it from a chronological standpoint, in 2013, we had our first purchase. We bought 10 at 10, so ending inventory had 10 units at $10. We then sold 5. Well, if we're using FIFO, we sold 5 out of the $10 layer, and we have 5 units left in ending inventory. We then went out and bought 20 units at 12, so now our ending inventory has 5 at 10 and 20 at 12. Then we sold 10. Under FIFO, those 10 units we sold had to be 5 from the oldest layer, 5 at $10, and once we exhausted that layer, then we go to the $12 layer, and we sold 5 at 12. So total cost of goods sold was 110, leaving 15 units of that 20 units left in inventory. Now, since it's the end of 2013, that's also the value of ending inventory, $180. If I total up everything in the cost of goods sold column for 2013, I would find that my cost of goods sold for the year was $160. In 2014, notice we just keep on rolling along. So we buy 10 units at $13, which means we have 15 at 12 from last year, plus 10 at 13 for this year. So when we sell 10, FIFO says the first one's in, that $12 layer. We sold 10 of those, and so we have left 5 at 12 and 10 at 13. We then go shopping again. We buy 15 at 15, and now we have 3 layers in ending inventory, 5 at 12, 10 at 13, and 15 at 15. So when we sell 10 units, they come from the oldest, 5 at 12, and then the next oldest, 5 at 13, leaving us a remainder in ending inventory of 5 at 13 and 15 at 15, or $290, and cost of goods sold for the year, 245, which is the sum total of all of our cost of goods sold. So to recap, LIFO, if we do it LIFO, notice, same situation. We bought 10, we sold 5. The last ones to come in are at the $10, so we have 5 at 10 left. We then go out and buy 20 at 12, so now we have 2 layers. So when we sell 10 units, we go to the last ones in, which were at the $12 layer, so we sold 10 at 12, or 120, and what's left is the oldest, 5 at 10, and the remainder of the $12 layer are 10 at 12. So our ending balance for 2013 is 170, and our cost of goods sold is 170. In 2014, we keep rolling along, so now we have 3 layers in ending inventory, so that when we sell 10 units, it comes from our most recent purchase, 10 at 13, leaving us our oldest, 5 at 10, 10 at 12. We go shopping for 15 at 15, back to 3 layers, but when we figure our cost of goods sold, it comes out of the most recent purchase, or the $15 layer unit. So we sold 10 at 15, and so we only have 5 of that purchase left at 15. So ending inventory for 2014 is 245, cost of goods sold is 280. To recap, notice that on our income statement, our cost of goods sold and our gross margin will differ depending upon whether we use FIFO or LIFO, and also the balance sheet amount for inventories, ending balance, will differ whether I'm using FIFO or LIFO, and that's true in both years. So that's a little bit on perpetual inventory.